Good morning, everyone. I'm Vince Lansing. This is the Gold Fix Market Rundown. There's the home page, and we'll discuss a couple of those titles there, a couple of popular titles there. Before we get started, a little bit of housekeeping. 2 days ago, I had the pleasure to sit down with the lovely and talented Tom Luongo. Always a good time there. And this time we talked for probably 2 hours, the first hour of which is going to be available uh, uh, to the public, and we discussed stablecoins, uh, kind of an addendum or follow up to his conversation with Caitlin Long. And from my perspective, or our perspective, I should say, we both share it, how we think the U.S. will use stablecoins to support the Treasury, monetize our payment chains, and assert dollar dominance while at the same time undermining or removing an addiction to the euro dollar dominance. Again, another knife in Europe's heart, possibly. But that's titled "The New American ATM Economy," and I have the link there for you all. You can see that. You can click on that. That goes right to Tom's site. And there's also another 45 minutes that we have taken to recording before we start recording. And that's pretty sometimes they're spicy. This one's pretty frank, and we're gonna share that with our founders. Some of it probably shouldn't get out into the wild too much. And Tom, I think, is going to share it with his Patreons. Anyway, uh, if you're interested in stablecoins and or you're interested in how we're going to support the U.S. Treasuries market with everyone selling, and or you're interested in how Bessent wants to along with Trump, reinvent U.S. finances in a classic corporatist fashion, that's for you. So there you go. Today we're going to talk about summer seasonality. Let's do the markets first. The dollar is down 4. The S&P 500 is 59.85, up 14. The VIX is 17.43, down 27. Gold is 33.48, down 5. It was up a little bit. So it's been between down 10 and up 5 all night. Silver 34.37, down 9 10 cents. Weak but not slammed. Opened up stronger. Copper 482, unchanged bid. WTI 63.72, up 11 cents. Natural gas 345, unchanged offered. Bitcoin 105 and change. Platinum palladium mix. Platinum is up 9. Gold silver 97 and change. Grains are all up. Pretty strong, actually. Corn is up the strongest in terms of percentages at 439.7, and wheat is 550.2. And China is nowhere in particular. We're going to talk about briefly, I'll just touch on some charts. Gold, of course. Bitcoin, the dollar on a monthly basis, if I can remember to bring it up that way, and silver, because that is a current event for everyone. Onward to the stories. Okay. In reading a market recap by a publication, a good publication, uh, uh, we were reading their recap of gold. And it goes like this. Gold fell after hitting a near 4-week high, pressured by a firmer dollar as investors grew cautious ahead of a potential call between U.S. President Donald Trump and Chinese leader Xi Jinping. Uh, so far, so good. Nothing wrong there, nothing bullshitting there. And then there's a quote: "We are moving into this period that is well known to be the summer doldrums." So there's an expectation that the gold market could fall into a bit of a lull or a sideways consolidation. And then it goes on, and I'm not going to say who the quote is by. Spot gold fell 0.78% to 33.52 an ounce, et cetera, yada, yada, yada. We all know what the market did. There's a problem with this. It's wrong. We are moving into this period that is well known to be the summer doldrums. There are no summer doldrums in metals. There's seasonality. Anyway, I could go off on ranting tangents here, but I won't. I'll just show you some data. Okay, so let's do that. This is a this is a monthly performance of gold for the last 30 years. Now, it stops 2021 is the last year we actually compiled this. This is work that Leon Tui did, the late great Leon Tui, someone I miss. Didn't know him that well, but knew him well enough to know that I miss him now. This is a chart that compiles if the market's up or down on a monthly basis for the last 30 years on the y-axis. So there's January on the left, December on the right. And I'm going to read you some numbers by month. Okay. These are average monthly 29-year. This is the 29-year average return by month, if you want to look at things that way. January is up 2%. That's because it's buy season. February is up 1%. That's because it's the end of buy season. And generally speaking, it does okay. March is the hangover and it's down. That's the third month. April, up, not crazy. May, up, not crazy. June, up, unchanged basically. July, strong. August, strong. September, strong. So the summer doldrums is bullshit. It's what you say when you're going on vacation and you don't know what to say and you just have to say something. And the press is moronic for taking it, okay? And that's why people like me make money because the people like you, unfortunately, are being informed by morons. Okay, October is a down month. November is an up month on average, but it's very volatile. And December is usually an up month. So that's the year. Any other chart you show me from the time cycles, they're wrong. They're wrong. That's just not how it works. They're looking at uh, how much it could go up. Great, it could go up 100%. I'm not looking at that. I'm looking at the probability of it going up. Okay, so October, it's going to go down usually. September could be very, very strong. August, remember the summer, could be very, very strong. July is usually an up month. June, unchanged. May, unchanged. April, a little bit higher. March, negative. You see, there are no summer doldrums for metals. The market goes up during that time frame. Maybe it drifts higher, but anyway, am I telling you to go out and get long for the summer? No, I'm telling you that you're getting information from people who don't know what they're talking about. If you're getting it from someone else other than people like me, not necessarily me, but people like me. All right. Um, enough with the rant, but that's basically it. So if just rant over. The summertime for precious metals, before we were crazy, we got crazy 2 years ago. The summertime for precious metals is a bullish time. The market will go up as we enter the new year from all the money coming in, and then it will drop because that money is uh, already in the market. People are taking profits, right? The new year is over, and then the market will drift sideways April and May, and then it'll start to uptick in June and July and August, and then you get into September, and it could be a very, very good month. But October is almost always a down month. Why? Because that's sell season. So we're not in a season right now. So you may be tempted to say summer doldrums are here. No, no, that's you going to your house in the Hamptons. The doldrums is you, not the markets. Anyway, things like selling may go away, sells newspapers. Anyway, that's the backdrop. Seasonality, they're going to start talking about seasonality because they have nothing else to talk about. And I have nothing else to talk about either today. So I figured I'd help you out a little bit. All right, moving on. This week, four stories. We had five, and now we have four. America at the Crossroads, 1970 stagflation, or 1990s Goldilocks. We did a HeartNet coverage 2 weeks ago called HeartNet Leaping from 1976 to 1991. And he was implicitly talking about that. So we ran with it. And it was well received. It was one of our more popular stories. And I think it appealed to a generation of people. There was a section in there that I talked about how between 1976 and say 1990, there was a stagflation recession era that wiped out a generation of union employees and mostly small businessmen. And my family was a big part of that. And I think that story, in combination with the explanation of what happened in the 70s to Yugoslavia, paint, I think, a very good, real example of what could happen if we don't get manufacturing back here. And I'm a little bit pessimistic about that today, if you can't tell. The post-COVID world and how everything changed. In 2022, I gave a lecture to my class about how the world was splitting into two parts, management and labor. And I gave that lecture again this year because it turned out to be true. So I'm going to write an essay on it to kind of maybe put a fine point on it as we head into the BRICS events. We're talking about the BRICS. End of the COMEX era, gold repricing and the rise of physical markets. And the coming war, there's a geopolitical piece that Mavs did, uh, who works with us now. And his title's different, but the coming war with China through Japan's eyes. Taiwan is a bone of contention. There's risk of a war. And I think it would help to look at it through Japan's eyes, which feels like it's, you know, in the crosshairs of the Taiwan Straits, if I can mix a metaphor there. Anyway, those are the things coming out. What did come out was, as promised, BOA says silver to $40 in 2025. That's They believe silver to $40 before gold to 4,000. I think that was the important part of their commentary. That's from a report that they did. Analysis: gold pricing implies treasuries are junk. I think that's kind of cool because everyone looks at gold rallying and treasuries going sideways yield wise. So why is gold rallying if treasury yields are still relatively high? Well, the answer is treasuries are not worth what they should be because they're confiscatable now. And gold is saying that you need another 5% in treasuries. If you look at their analysis and take it for face value, take everything with a grain of salt. But if you look at gold's pricing at face value relative to 30 years of relationship with treasuries, you come to the conclusion that yields have to be 10% for people to feel significantly compensated enough to take the risk in treasuries. That's on the BRICS side of the world. The rest of the world is just going to do what the US wants to because they're all clients of us. Why did silver get slammed? We'll touch on that a little bit here. Founders Commodities Monthly, that was a nice little piece there. And GoldFix PM, tacos and silver. The data on deck for Wednesday is ADP unemployment. That'll be out by the time we're done. We're done. We're almost done, and it's out. 9:45 S&P final U.S. PMI. That'll probably be a week. I'm not sure. Fed beige book is today at 2 o'clock. But the big thing this week is going to be unemployment on Friday. All right, so let's just go through these charts quickly. So we start with gold on the daily, just to touch base with it, right? Daily gold to beat a dead horse. There's the bottom of the range, and there's the top of the range. Now this was the top of the range, and now we've extended it. So I believe it's really reasonable, without being crazy bullish, to say, you know what, this range is broken out, and unless we get back below 33, oh shit, we're right there. Unless we close below 33.55, you should think that the market is now in a new structure that it wants to create and test this area here. So not to put a black like 33.55 and everyone dies. It's kind of like if we settle below 33.55, your spider sense should tingle. If we trade below 33.33, call it 33.35, you should say, it's not going to happen. We're back in the range again. And then you'd assume that we're going to go to the bottom of the range and this whole oscillation starts. For God's sake, I hope that doesn't happen because I have silver options. So we'll go to silver next. All right, so we're in day 3 of a 5-day bull signal. And I'll just take the Bollinger Bands off so it doesn't give you a headache. This should be a bull flag and the market should go higher today, tomorrow, or the next day. If it does not, well, then this will just collapse and the market will go back into here. So if you think about it, gold and silver have a similar formation, with silver being much more exciting, meaning silver was in this range and it got above it, and it actually got above this. So silver's on its way to outperforming another leg higher if it can hold above here. So if it drops below here, same idea as gold, then assume that we're going to touch here. Okay, so here's the range. We've really cleared it. And here we are touching up against um, um, 35 again. I have a mental block on that number. I'll show you what I'm talking about. There's the weekly gold. Look at this. 35 rejected soundly. 35 rejected soundly. So I want to bring this up because Jordan pointed this out. Oh boy, Jordan Roy Byrne of the Daily Gold pointed this out to me yesterday. I sat down with him, and that'll be out. Uh, that conversation will be out in a day or two. But I want to show you something that he focuses on a lot more than I do, but I focus on it when he does. This is the quarterly for silver. Okay, the quarter matters because that's when money is reallocated. That's when people do their fiscal quarter, fiscal year. And if the market closes, I'm not sure the exact number, but he is. But if you take a look at the markets right here, right? Look at that wick below. The market's right here. If the market closes here or higher, it might be right here. But if the market closes, let's say 35, let's call it 35. It'll be the highest quarterly close, the second highest quarterly close of all time. Now, if that happens, macro discretionary is going to come back. They never were in silver, but they're going to come back into the market and they're going to buy silver. And we will have a nice run. That's my opinion. The question is, will they come back on the COMEX? Probably not. They'll probably buy in Shanghai because it's cheaper there. The margin requirements are lower there. It's a bull's paradise. Why would you trade long on the COMEX? Um, anyway, so that's the play. The play is if June closes at $35, you want to buy a seatbelt because the rocket ship will probably take off. If it doesn't, then we live to fight another day. But this is a pretty interesting chart when you look at it that way, and I do look at it that way whenever whenever Jordan and I sit down. Bitcoin, that's a monthly. I want to go to a daily. I'm I'm long, right, and I'm scaling in, adding, uh, not as a trade. Okay, um, see this. This is the golden cross. And this is another, this is the golden cross. This is a big bullish cross. And this is another cross. And the market ran up, but when it got to this one, it did nothing. Okay. So I want to just give you a technical observation. This is supposed to be wildly bullish, 50-day crossing, whatever this is, the 200-day. And the market ran up approaching it, and then it got slammed. This is bearish, the move from a moving average point of view. The market ran up, and then when the cross happened, the market did nothing. So I would tend to think that the market can be rolling over here and headed lower. I'm not married to that, right? I'm not saying to get short. I'm not saying to get long either. I am saying that, see this whole structure here, this whole daily structure? Again, I'm long on a trade. It's an entry, but it's a trade, expecting 100 at 110, we'll go to 130 before we go to 100. And that's my trade. I mentioned that before, and I still have that on. But I'm starting to get a little concerned because this is supposed to happen faster. And this should have given us a little bit more of a boost, and it did. So just be aware that, I might be backing off on my on buying more. The dollar, I think, is the most interesting chart out there right now, just from a point of view. Look at this. Look at this market. Since the war started in 22, the dollar has been strong because the yields have been lower, right? I'm sorry, higher. Bonds have sold off and the dollar has strengthened. And that happened all through here. And now we're looking at yields creeping up as the dollar's dropping. So just looking at it technically, we're below 100. Okay. We've been here for years between from November of 22, this is the war, people buying it because of the war, and then people realizing it's all bullshit. and this is the market doing this, and now here we are below 100. This whole structure might be closed off now, and we could head back lower. And I know there's a lot of people short out there, and they're looking at it this way, and we could have a short covering rally, but this is a monthly chart. I think we're in increasing danger of a pronounced, prolonged sell-off. And I look at it that way because Trump's going around saying, buy our treasuries and we'll hedge, and you can hedge the dollars, buy our stuff and we'll give you deals. The dollar is just going to get weaker. It has to get weaker. Okay. And by weaker, I mean weaker versus the other G7 countries, at least, for a year or two. Anyway, and plus it hurts China. I just think this is an interesting chart from a monthly point of view. And of course, if we go all the way down to the 2014 level, you're talking about the 70s, when when the dollar was in the shitter. So I guess it's about the yen now. I don't really have a strong opinion on it. Anyway, look for these stories this week, and the other stories on the front page. Have a great day. I'm Vince.